We're going to talk about how to complete a statement of cash flows. The statement of cash flows is based on a company's balance sheet and income statement. It's a very important part of the financial statements because it tells us where did our cash go, where did it come from. Net income is certainly an important indicator of how well a company's doing, but it's not enough. It doesn't tell us actually how much cash we used or gained from operating the business. And running out of cash is certainly a reason that many businesses fail. They may have reasons why they show a small amount of net income or negative net income and can survive that, but very few companies can survive continued cash outflows. And we have to look at this because net income, as we said, is not enough. Here, this year, Corrigan Corporation made $18,408, but let's look at their cash account. Their cash only went up by $7,000. So somewhere between the $18,000 and the $7,000, some cash went out the door, and we need to figure out why. Now, the good news about a cash flow statement is when we're doing them, not forecasting, but doing them for years past like this, is that we actually know the answer. And we won't put these in here going forward, but we know that our net, in this case it's an increase in cash, our net increase in cash is going to be $7,000. We know we had $65,000 at the beginning of the year, and we know we ended up the year at $72,000. So everything we do in the statement of cash flows is going to have to add to this or provide this net increase in cash of $7,000. We're going to complete the three parts of the statement of cash flows. One pertains to operating activities, one investing activities, and one financing activities. The operating activities section starts with net income. Net income is, of course, primarily from operating activities, our sales, less our cost of goods sold and other expenses, and of course our depreciation expense as well. So the first thing that we're going to add back to net income is our depreciation and amortization expense, and that's down here on the income statement. And we add that back simply because it's a non-cash charge. We've treated depreciation as a reduction from revenue. It's included in this net income number, but we didn't write a check to anybody for $159,000. We just recorded an accounting entry of $159,000. That accounting entry did not affect our cash. Nobody wrote a check from our checking account when that depreciation and amortization was recorded. So first thing we're going to do under operating activities is add back that depreciation and amortization. The next thing we're going to do is look at our change in accounts payable and our change in accruals. We can see from the balance sheets from last year and this year that our accounts payable changed by $22,500. That is, it went up from $409 to $432. Now, will this be an increase or decrease to our cash? We've increased our accounts payable. That is, we've increased the amount we owe to people. It's similar to borrowing money. This, of course, is done with our trade creditors and for our expenses, not in the financial markets, borrowing money from a bank, let's say. But we did, in effect, borrow money. And if you borrow money as a company, that's a positive to cash that's otherwise not reflected in net income. Our accounts payable could be higher, could be lower. That wouldn't have changed this net income number. So we have to add back to net income our increase in accounts payable. Similarly, Accruals are the same type of thing. We've recorded expenses that we didn't have to pay. Maybe the bill wasn't due, maybe it was vacation pay, what have you. And so we have to record, in this case, an $8,000 increase in what we, in effect, owe people, or what we expensed but didn't have to pay for in cash. So we're going to add these two items also, as well as the depreciation and amortization, back to net income. So we've recorded these changes, and you'll see that we're keeping a running total. This interim number doesn't really mean anything, but eventually we're going to want this net change in cash to equal what? $7,000. So as we get through the whole statement of cash flows, that should compute to a $7,000 increase. So let's continue looking at our cash flow from operating income, operating activities. The next item we'll look at is the change in accounts receivable. And here we see accounts receivable went up a lot, from $328,000 to $439,000. So we have a lot more of our customers owe us a lot more money, and in fact they owe us $111,000 more. So we know that the amount that's going to go here is going to be $111,000. Is that going to be a positive number, that is an increase to our cash, or a negative number, a decrease to our cash? Well, if we've increased our accounts receivable, there's a couple ways of looking at it. One is that we've essentially loaned more money to our customers. So we increased that loan by $111,000. So if you loan somebody money, the idea is, of course, that you're spending or giving them cash. So that's one way of looking at it. The other way is very similar, and that is we have a sales number of 4240, but and by running that through the balance or the income statement down through net income, that is done as if all the sales came in for cash, but of course they all didn't come in for cash. So this number, if we were doing this on a cash basis and not an accrual basis, is really sort of overstated by $111,000. We didn't collect in cash all of that $4,240,000. So here we're going to have this be a negative number for our change in accounts receivable. And then finally we'll look at, for the operating cash from operations, we'll look at inventories. Inventories, we can see here, also increased. This increase in inventories from $813,000 up to $894,000 is an $81,000 difference. So we're going to have a change in inventories here of $81,000. Again, will it be positive or a negative? Will it be an increase to our cash or a decrease? It will also be a decrease to cash or a negative number. And again, you can think of it, one way is to think about this income statement having been generated based on, as of the morning of December 31st, let's say, all your sales, expenses, and everything else accounted for. And then that day, you bring in $81,000 worth of inventory for which you have to pay cash. If that were the case, the income statement doesn't change. It won't reflect that change in cash. It's only reflected in the inventory account. So we'll have to decrease cash to indicate that we've purchased a whole block of inventory. Now, in reality, of course, this just occurs over the course of a year, and that's not generally the way that inventories would change. But as an example, or if that helps conceptualize it, think of it as that last day or that last hour, a lot of inventory coming in the door. Again, a decrease in cash. So we now know our net cash from operations. It's $15,908. We can see that we had net income, added a lot of depreciation, and then we made made a little bit of cash by our change in receivables and accruals, maybe stretching out our payables a little bit, but we really spent a lot of money or spent a lot of cash on our increase in receivables and bringing in a lot more inventory. But our net, 15,908, and you can see that interim number, if you will, has been added in down here.